Here's a question almost nobody can answer about their own life. What's the exact dollar amount you'd need sitting in the right kind of account to never have to work for money again? Not a lot, not enough to be comfortable, an actual number. Most people have never calculated it, which means most people are chasing a finish line they've never actually defined. And here's what makes that dangerous. Without a real number, financial freedom stays a feeling instead of a target, which means you can't tell whether you're 1 year away or 30, whether the extra hours you're working are actually moving you closer, or whether an entirely ordinary decision, like a car payment, is quietly pushing that number further out of reach. By the end of this video, you'll have calculated your own version of that number using the exact same formula wealth planners actually use. And you'll know the specific, quantified levers that move it faster. Not vague advice like spend less, but real numbers run properly. Here's what you'll walk away with. 1. A formula called the Rule of 25. The actual calculation behind the number that defines financial freedom run on a real example from start to finish. 2. The single most common decision quietly keeping around 100 million Americans further from that number than they realize, and the exact math behind why it costs so much more than it looks like. 3. 5 concrete run-the-numbers levers, covering housing, transportation, everyday spending, taxes, and income that move your own number closer, faster than working harder alone ever will. Let's start with the number itself. Financial freedom means something different to almost everyone, which is exactly why it needs a number attached to it, not a feeling. The starting point is figuring out what a fully funded version of your life actually costs per year. Housing, transportation, food, insurance, travel, the ordinary bills, and some room for enjoyment. Run a real example. Say a one-bedroom apartment in a major city runs around $30,000 a year. A nicer car, including fuel, insurance, and maintenance on top of the payment, comes to roughly $24,125 a year. 3 mid-range trips a year land around $5,000. Utilities for that apartment run about $3,000. Food, mixing home cooking with eating out, comes to around $5,000. Health insurance in the U.S. for a mid-level plan runs about $2,500. Leisure, gym, nights out, incidental spending, adds another $4,000. Add all of that up, and the total comes to $75,325 a year to fund that specific lifestyle. Now the actual formula. Take that annual number and multiply it by 25. That multiplier comes from something called the Rule of 25, a widely used approximation based on the idea that if you can safely withdraw around 4% of an invested portfolio every year without depleting it over the long run, then the total portfolio needed is simply your annual spending divided by 4%, which is mathematically the same as multiplying by 25. $75,325 multiplied by 25 comes out to $1,883,125. That's the actual number. Not a vague sense of eventually, not a few million probably, a specific figure that either gets closer or further away depending on the decisions made this year, this month, this week. Think of it like a tree that produces a fixed crop of fruit every season. As long as you only ever eat the fruit and never cut into the tree itself, it keeps producing indefinitely. The Rule of 25 is simply the size of tree required to produce enough fruit to live on forever, based on a historically reasonable withdrawal rate. It's worth being honest about the assumption underneath this, the same way any projection deserves scrutiny. The 4% figure assumes a diversified invested portfolio generating real returns over decades, not cash sitting idle. The S&P 500's average annual return over the past decade has run higher than that historical baseline, and no 20-year-plus holding period of a broad index fund has, historically, resulted in a net loss. But past performance describes history, not a guarantee, and the 4% assumption is a long-term planning approximation, not a fixed promise. Here's a decision that looks completely ordinary and quietly does more damage to that number than almost anything else on this list. According to LendingTree, the average monthly payment on a new car in 2024 hit $734. Run that over a year, and it comes to almost $9,000 every single year, often for 5, 6, 7 years in a row. And this isn't a rare situation. There are currently around 100 million Americans carrying an outstanding car loan at any given time. Here's the part that doesn't get said enough. A large share of people making that payment are stretched by it, not comfortably absorbing it. Meanwhile, the appearance of driving a newer, nicer vehicle gets read socially as a signal of doing well financially, when in a huge number of cases, it's actually a monthly liability chosen specifically to project that signal. The alternative isn't never own a nice car. It's what's sometimes called car hacking, buying a quality used vehicle that's already passed through the steepest part of its depreciation curve, driving it for a few years, and selling it for close to what you paid, instead of financing a rapidly depreciating asset at nearly $9,000 a year. Run the rule of 25 backward on that $9,000. Eliminating it doesn't just save $9,000 once. Structurally, it lowers your entire required freedom number by $225,000, because every dollar of annual spending you don't need gets multiplied by 25 in the target you're chasing. That's one decision. Now the smaller ones run the same way. A comparison worth actually doing the math on: a well-known name brand cereal running around $4.25 a box against its unbranded store brand equivalent at roughly $1.66. And the store brand box often contains nearly twice the product by weight. That's a savings of about $2.56 per swap, and a broader study from a consumer savings research group found people can save up to 87% by consistently choosing generic overbranded goods in comparable categories. $2.56 by itself isn't going to move a $1.88 million target, but run it as a daily habit rather than a one-off. $2.56 saved every day comes to $934.40 a year. Sustained for 5 years, that's $4,672 from one small, repeatable swap with no lifestyle sacrifice attached to it, since the underlying product is often functionally identical. The pattern that matters here isn't cut small joys. It's that small, repeatable, no-sacrifice swaps compound the same way investment returns do, quietly, in the background, without requiring ongoing willpower once the swap becomes the default. Housing is typically the single largest line item in anyone's freedom figure calculation, which makes it the highest leverage place to make a structural change rather than a habitual one. One version of this, sometimes called house hacking, involves buying or renting a property with an extra unit or room rather than a standard single unit, living in one part of it and renting out the rest to cover most or all of the mortgage or rent. Structured well, this can mean living at or close to zero net housing cost while still building equity in the property, rather than simply paying that cost outright every month with nothing built up in return. A related, more accessible version applies even to renters. A well-located rental listed short-term can sometimes cover its own monthly rent in a fraction of the month. As a rough illustration, if a rental costs $4,000 a month and a comparable short-term nightly rate covers that same amount in roughly 10 nights of bookings, the remaining 20-plus nights of the month become genuine surplus rather than a wash. This kind of arrangement carries real logistical requirements: a location and unit that actually books well, and, importantly, clear upfront agreement with a landlord before attempting it, since doing this without permission on a standard lease can create serious problems. The exact version that fits will vary by city and situation. The underlying principle doesn't. The largest expense category deserves the most deliberate structural thinking, not just the most frequent daily willpower. Housing and transportation cover what goes out. What about what happens to the portion you're not spending at all? Is that money actually working as hard as it could be? Legally reducing what you owe in tax isn't a loophole reserved for the wealthy. It's built into the same tax code everyone files under, if it's actually used. Anyone running even a small side business or freelance income can typically deduct legitimate business-related expenses, a home office portion, business-related travel, equipment used for the work, reducing taxable income by the amount actually spent running that activity. Separately, tax-advantaged accounts exist specifically to shelter growth from tax entirely or defer it. In the UK, an ISA allows up to £20,000 a year to grow completely tax-free. In the US, a Roth IRA offers a comparable structure. Understanding and using the exact rules available in your own country is the entire mechanism, not aggressive maneuvering, simply not leaving a legally available benefit unused. Credit deserves a direct correction here too, because the common advice young earners receive is frequently backwards. A credit card, used responsibly, a modest balance, paid in full every month, is one of the most effective tools available for building a strong credit history. And that credit history directly determines borrowing costs for the rest of your life. Someone who builds a strong score in their 20s can qualify for a meaningfully lower mortgage rate a few years later. Someone who avoided credit entirely, believing it to be inherently dangerous, often ends up with a thinner credit file and a worse rate on the exact same loan. The mechanism isn't complicated. A credit card isn't dangerous by itself. An unpaid balance is. Used deliberately, it's a tool for lowering future borrowing costs, not a threat to avoid entirely. Relying on a single paycheck as the entire foundation of a financial plan is structurally fragile in a way that's easy to underestimate, because it works fine right up until it doesn't. Picture a stool with exactly one leg. It holds weight perfectly well until that one leg fails, and there's nothing left keeping it upright. A single employer, a single income source, is that one-legged stool. And job security today is measurably less stable than the framing "get a secure job" implies. The average worker holds roughly a dozen different jobs across a career, not one job for 40 years. Adding even one additional income stream, freelancing in an existing skill, a side business, deliberate investing, adds a second leg. Add a third, and the structure becomes genuinely stable. If any single leg fails, the other two continue holding weight. This isn't an argument for working every waking hour. It's an argument for not structuring an entire financial future around exactly one source that could disappear with a single decision made by someone else. Here's the distinction that separates people who reach their freedom number from people who never quite get there, regardless of income level. One group treats money as something that exists to fund a lifestyle, pay the bills, buy the things, maintain the appearance. A second group treats it as a tool for accessing larger loans to buy bigger houses and nicer cars, which sounds like progress, but usually just means a bigger version of the same one-directional spending. A third group treats money's actual function as expansion, using money to generate more money so that a portion of it is always working independently of active hours worked. This is the exact point where a rising income either compounds into freedom or evaporates into a nicer version of the same treadmill. The moment income increases, the instinctive move is to expand lifestyle to match it. The alternative, directing that increase into something that generates further income rather than simply spending it, is the entire difference between working harder every year indefinitely and eventually reaching a number where working becomes optional. Broad market index investing remains one of the most accessible starting points for this, requiring no specialized expertise and available with very small starting amounts through nearly any modern brokerage. More volatile assets, like cryptocurrency, can be a small, deliberate part of a portfolio for those comfortable with the added risk. Genuinely deliberate, sized so that a full loss wouldn't be financially damaging, not a core strategy. And real estate remains one of the most powerful wealth-building tools available, at the cost of requiring more upfront capital, whether through direct property ownership or the house hacking approach covered earlier. Here's what all of this adds up to. Financial freedom stops being an abstract, someday feeling the moment it becomes an actual number. And once it's a number, every decision in a normal week can be measured against it directly. A car payment isn't just $734 a month anymore. It's $225,000 added to the target you're working toward. A small brand swap isn't just a couple of dollars. It's thousands over 5 years, compounding quietly with zero ongoing effort once it's the default. A second income stream isn't a side side hustle for extra spending money. It's a second leg under a stool that was never designed to stand on one. None of this requires an unusual income or a lucky break. It requires calculating the actual number and then treating every financial decision, housing, transportation, taxes, credit, income, as either moving that number closer or pushing it further away. That's the whole system. Run your own number today using your own real expenses, and you'll know, for the first time with genuine precision, exactly how far away freedom actually is.